Frequently asked questions, capital gain taxation. In this segment, we're going to look at the different components of taxes that will be paid if somebody sells a property for cash rather than doing a 1031 exchange. One of the important things to be aware of is that the taxes, there really are four different components potentially that a taxpayer will have to pay. And let me review those kind of in the order they're calculated. The first tax is a tax on the depreciation recapture. This is taxed at a rate of 25%. So the depreciation that somebody has taken over many years, if the property is sold in a taxable sale and does not go through a 1031 exchange, that depreciation recapture is taxed at a rate of 25%. Then the remaining economic gain, there are federal capital gain taxes, and those would be either 20% or 15%, depending upon the taxpayer's taxable income. Next, when it's applicable, some taxpayers may face the 3.8% net investment income tax. So this is over certain threshold amounts, which we'll cover in just a moment. So this generally would apply to sellers that sell highly appreciated property, or oftentimes in commercial transactions where there's significant gains. And then finally, the fourth and last component is the taxpayer has to look at the state tax rate. So some people are in situations where there's no state tax. There are a number of states like that: Florida, Texas, Wyoming, and a handful of others. But most taxpayers are also going to have to add in the applicable state tax rate. And as you'll note on the screen, this can be a big factor. State taxes can go as high as 13.3%. That's the maximum tax rate in the state of California. You would have to look at your state tax rate to determine what would apply to your particular situation. Now let's look a little bit more detail at the capital gain taxes, in particular the federal capital gain taxes. So there's a 20% rate for taxpayers that have over $400,000 of taxable income for single filers, or over $450,000 of taxable income for married couples filing jointly. And one thing to take note of here, you'll see that it's $400,000 for single filers and $450,000 for married couples filing jointly. There really currently is a significant marriage tax penalty. Below those threshold amounts, the capital gain tax rate at the federal level is 15%. And then when we look at the 3.8% net investment income tax, this is a tax that applies to any net investment income over certain threshold amounts. And so the threshold is $200,000 for single filers and $250,000 for married couples filing jointly. Again, just want to point out that you do have a significant marriage tax penalty to take into account. Section 1411 defines what is net investment income, and it includes a lot of different types of income, including interest, dividends, income from partnerships, retirement income. But you'll see in blue it also includes capital gains, and so this applies to some taxpayers. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.